It's Wednesday evening, January 27th. The market's been closed for 3.5 hours, and that means that it's time for the weekly swing trading video. Hello, traders. We've got a nasty market that we're dealing with in a very difficult position. If you are watching this on YouTube, that means that I've released the video after my members have had a chance to adjust their positions. Lots of education. You're not going to see any new picks per se, but you're going to be able to see how we work our way out of a very difficult situation. Lots of really good educational material here. If you've ever been in a bad trade, if you've ever been in a pickle and you're wondering, what do I do now? This is the video that you want to watch. I play a lot of chess. I've been going through a lot of scenario analysis. I've been trying to think of how I could possibly work out of this situation. Lots of risk involved in the positions. I also only send alerts for the swing trading that I do in the account after the market closes. That means that I can't make any adjustments during the day, and I am truly handcuffed. I did make some overall adjustments to my portfolio during the day today, so I was able to mitigate a lot of the risk. You aren't able to do that in these swing trading videos, so I'm going to go through everything that I've had to take into account, and then I'll drill down to what my strategy is for our current situation. So before I do that, let's go into the staged order entry screen, and I've got some good news. It's not all bad. The first position here, AXP January 22, 115, 114 bullish put spread, that expired last week. So let's remove that. We also had the J&J, Jan 22, 155, 152.50 bullish put spread. That expired worthless. So I'm going to cancel that out of the staged orders. Texas Instruments, 165, 162.50 bullish put spread. That expired last week. So I've been watching this portfolio of trades thinking tick, 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 time. Please just tick away. I want to get to the sidelines. I want to get to cash. You know that you've been watching all my videos. I've been sensing that the market is setting up for a pullback. I thought we had a chance for a buying climax this week on the heels of probable stimulus bill, which is still out there, and Democrats are saying that with or without Republicans, they're going to push it through. So we should see a huge liquidity injection. I also figured the FOMC minutes today, they're going to be super bullish. The Fed's going to tell us about all their money printing. They're going to keep up quantitative easing. All of that was already factored into the market. Didn't care. I thought that reassurance might still keep buyers engaged. Never fear. Microsoft announced earnings. It rallied after the number yesterday, Tuesday. It didn't help the market today. Market opened lower. Well, that's okay. We've got Facebook and Apple and Tesla that are going to report earnings today after the close Wednesday. That certainly is going to keep buyers engaged. Now, Apple's down. Tesla's down. Facebook is down. S&P futures are down 30 points after hours as I record this video, so we're going to have a weak open tomorrow. That's not going to set up well for our positions. There are some key market levels that we've got to take a look at, so let's start there. We've had this nice upward sloping channel on the SPY. As long as that stayed intact, we're in good shape. I thought we might blow through the upper end this week and then pull back hard. Market couldn't wait that long. Monday, I was already starting to get a little bit nervous because we had a 60-point drop Monday morning. Whoosh! And that showed us that the selling can come very, very quickly. But look, market rallied all the way back. And these are the violent types of swings that you get in an 11-year bull market, in a 10-month bull market. These bullish rallies die very hard. So as soon as you start breaking down, there's a chance that boom, you can go right back up again. No problem. These sell-offs don't typically last very long. Could this time be different? It could. Are we going to get a nice long red candle tomorrow on the heels of tech giant earnings that came out and had negative reactions today? Possibly. This SPY 372 level is critical support. If we break below it, We could start moving down towards the beginning of this channel here, and that takes us all the way down to the 100-day moving average. Well, that is where I'd like to be a buyer, but we don't know how long it's going to take us to get there. And you can see it comes into play right around 356. There's a horizontal resistance level. That's the bottom end of the channel, also around the 100-day moving average. So lots of room to move to the downside. Well, what exactly was the news today that sparked all of this selling? Was it the coronavirus? No, that news has been out there. Well, what exactly was it? With stocks at a PE of 40, valuations are rich. Some of the short squeezes that we've seen, my God, where is that coming from? You've got social media driving all of this action, and then institutions, once they smell blood, they're going to be in it. And you've seen thousands and thousands of option contracts going off. I know the institutions are putting the squeeze on too. So it's not just retail doing this, but the short squeezes that we've had, look in this heavy buying list. These stocks are like skyscrapers, straight up. GameStop, of course, everybody's heard of what GameStop is doing. Absolutely crazy stuff. Perhaps that's setting up for a bigger market move. I think this stimulus bill is going to get passed, and that's going to put a lot of liquidity into the market. Here's what I can envision. The lower end of this trading channel gets broken. You get bullish speculators flushed out. We have a nice big drop down in here, and all of a sudden you get bearish speculators piling in. You find support, and then you go boom right through the top of the upper end. That would be a nasty, nasty scenario. So we've got to protect ourselves against that also. Anything can happen right now, and I'm sad to say that I'm snared in my own trap because I've been warning you for the last 2 weeks. Be cautious with swing trades. Be cautious with swing trades. Go to cash. Go to the sidelines. This is really a tenuous situation. Upside reward, smaller than downside risk. Anything can happen. Bullish sentiment off the charts. Margin lending off the charts. VIX super, super low. All of these things are adding up to a possible market correction. And here we are, 2 days before our positions expiring, having to do some hand wringing. So, how are we going to attack the situation? Well, I'm going to show you the stocks one by one. We'll take a look at NET. That'll be first on the list. And I'm just going to go through our positions. I'll move this back in on NET. We are short the January 29th expiration, and you can see the first three trades I'm going to focus on, and the ones that I'm really primarily concerned with are this week's expiration. You can see that we've got the Netflix or NET 7250 puts that we're short, and we're long the 70 puts. So 7250, that's our strike price. I'm going to put up NET. We'll take a look at the stock itself. And here you can see it's holding the support pretty well. The stock finished at 74.58. Not too bad. We're still out of the money by a point and a half, 2 points almost. So 72.50 is our strike price. So I can bring up those option orders and show you where those options are trading. Here's the problem. The stock really hasn't broken down yet below this technical support. Let's take a look at what it did today. You can see the stock dipped with the market. Then it spent most of the day actually grinding higher. It showed nice relative strength. I wasn't too worried about it. We're all the way up to 77.50. Not too shabby. So, late day selling in the market, stock started to lose its steam, and then now here we are, $2 out of the money. Well, if it has another day like today and it loses $4, we're in the money on it and we are in trouble. But what if the market opens lower tomorrow, the stock finds its footing, and then it rallies up? If we try and leg out of NET and we try and buy back these short puts, and then we try and sell the long puts, we could get really, really stuck in a bad way because we might not be able to sell our $70 puts that were long. So I'm going to take a look at all the option premiums right now so that it better illustrates what I'm talking about. And so here's the position. We are currently short the 72.50 puts, so those are 74 cents bid, offered at $1.25. Stock, let's say that it opens a little bit lower tomorrow. Let's say we have to pay $1.50 to buy those back in. Well, we would need to sell these $70 puts for $1.50. Well, look, they're 10 cents bid, offered at 55 cents. You can drive a super tanker through that bid-ask spread. That's one of the problems that I've been mentioning to you, is that if you think you're going to be Jack be nimble, Jack be quick, and you're going to be able to get out of these, what do the market makers do? They spread these option bid-ask spreads out so you can't get out of the trade. That's a problem for us. So we don't want to take that kind of risk. And in fact, the same thing could happen for NET, Walmart, could also happen for Lyft. So we've got to be super careful with only 2 days left to go and everything needing to go perfectly. What do I mean by that? I mean the market's got to open lower tomorrow, and it's got to continue to sell off, and it's got to sell off lower than SPY 372 to gradually get that momentum building to where the stock keeps falling, 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 falling. Only then would this strategy be successful, and with these wide bid-ask spreads, who knows how long it might possibly take for us to get filled. If we were to buy these back at $1.50, it'd take a long time for these to get to $1.50. We can't risk anything like that. We've got to stick with NET. So let's say that we're looking at Walmart. Let's take a look at that position. Now on Walmart, we're actually short a $1 wide spread. We're short the 143s and we're long the 142s. So let's take a look at those. And we'll go down to the 143 and 142. Again, super important that you understand exactly what we're doing here. This is the spread that we have on, and I'll click the opposite way because this is what we'd have to do to exit the trade. And you can see that this spread is 19 cents bid, offered at 41 cents. Still not in too bad a shape. Walmart actually finished out of the money as well. But a similar situation here, at least because we have $1 between the strike prices, the deltas are going to be fairly high on the 142 puts, even with just 2 days left. But we buy these back for 125, let's say, market rallies tomorrow. There's no way we're going to be able to sell these puts for $1.25. We are going to be left holding the bag and taking an even bigger loss. Legging out of spreads, extremely difficult. So, not really a viable solution for us. What else can I do? Well, let's take a look at the final trade, and that is LYFT. Let me bring up the Walmart chart first, though. Walmart got hit really, really hard today, and I can't rationalize why it took such a big drop, because typically Walmart is one of those defensive type of stocks, consumer stock, really stable business model. If there's fear in the marketplace, typically Walmart is the kind of stock that's going to hold up really well. The only way that I could really rationalize what was going on, they've had a CEO change recently. Okay, so maybe the new CEO is not going to do as good a job. I don't know if that was the complete factor or not, but I do suspect that a lot of pairs traders who have been long Walmart have been short some of these other stocks like BBBY. So they're short BBBY, they're long Walmart, and when BBBY takes off to the moon, they've got to cover that BBBY trade. They've got to buy that baby back in at whatever price they can. And there have been a lot of these retailers, especially the brick and mortar firms that have a lot of short interest. Well, as these quant firms are having to buy back that short position, they've got to unwind the whole position. That means that they've got to sell a stock like Walmart. The pair is off. They're taking the trade off. They're closing it. So that might explain why there was so much pressure on Walmart, but it definitely broke down today uncharacteristically. And you can also see how it just closed below that 100-day moving average. That's a support level that we were leaning on. We were expecting it to hold. We actually were leaning on this just below the 100-day moving average. Very smart tactic on our part because we don't have to worry about these tiny little head fakes. If the market drops tomorrow, it's probably going to close below that support level tomorrow. Well, what if the market bounces? I'm expecting Walmart to bounce right back up and then the spread expires worthless. Another situation where we cannot leg out of this position. LYFT, similar situation there. This stock broke down and it broke that horizontal support. Here on Lyft, we're actually short the Lyft 45 puts, we're long the 44 puts. Then we did that for a 20-cent credit. Stock was up here, looked great yesterday. That's how these things change. Everything looked great yesterday. Today, not so much. So here we've got a situation where we'd have to buy back the $45 put, and then we would be able to leg out and sell the $44 put. Out of all of our positions, this is the one that I would be most likely to leg out of because it's a $1 wide spread, and we'll bring up the options. The stock moves, and this is a pretty significant technical breakdown. You can see how the stock has had some relative weakness here recently. And I believe there's some legislation that's being considered right now too with Lyft and Uber having to do background checks. And there were some stories in Chicago about Lyft drivers having their cars stolen and how they were demanding that there'd be a greater security check that's done. In any event, we've got the 145, the 45.44 bullish put spread. Here you can see those are $2.22 bid, and those would be the ones that we would buy back. But we've got 12 contracts of these. So that right there would be about $2,500 that we would have to spend just to buy back that short leg of that spread. And then we would be looking to sell these. Also, wide bid-ask spreads, 17 cents here and 14 cents there. So you're talking about very, very wide markets and a very risky strategy just 2 days out. Gosh, if we just had just another week to do this, it'd be much different. I had mentioned Netflix, kind of a lost cause. Nvidia, not a lost cause just yet. Still out of the money. It is going to expire a week from tomorrow. We will address that next week, and I'm going to put a position on that will resolve some of our problems, and I'll talk you through why I feel this is the best strategy for us to take. So, again, tried to get cute with our positions, I was trying to get to the sidelines, and look, here we are 3 days before expiration when a third of our positions would have gone off worthless, and we're in trouble. Well, that's how it works. So we have to be able to adapt. We have to adjust. We don't want to panic. Got to think through this rationally. How might this be resolved? So one thing that we can do is it's market risk right now that's of greatest concern. I'm not overly concerned about stock risk. The reason that our stocks are heading against us is because the market has fallen so sharply. I can't risk buying puts on individual stocks right now and taking advantage of relative weakness because what if those stocks find support tomorrow? What if they don't drop with the market? Okay, well, we could buy SPY puts. That would be one possible solution for us. However, those SPY puts move like the wind. And what I mean by that is, let's say that the market sells off tomorrow. We'll go back to the S&P 500 and we'll take a look at that. Let's say that the market sells off tomorrow. We break down below 372. It finds support and then we skyrocket right back up and we close above 372. If we buy SPY puts tomorrow on the open and the market does that, we're going to be really left holding the bag on those puts because they're going to lose their value very, very quickly. There's another way that we can hedge our position. This is something that I did in the chat room today. I saw that there were some dark clouds on the horizon. So what I did was I bought some VXX calls. And you can see VXX really spiked, and it could get above the 100-day moving average tomorrow. This is a measure of option implied volatilities. As the market declines, option implied volatilities spike. Well, guess what? Option implied volatilities have been going up with the likes of all the short squeezes that we're seeing right now. Anyway, now this is on the index, but I feel that that volatility is not going to be contained to stocks. It's going to spread into the overall marketplace, and we've already seen that Monday morning with that 60-point S&P 500 drop, and today with a 100-point S&P 500 drop. You can see how VXX has been able to move easily through this horizontal resistance level. It's probably going to hit a little bit of resistance at the 100-day moving average, but if the market cracks down and we get into this position early, right out of the gate, we are going to make money on our VXX position, and it will offset some of our losses that we would have on our bullish put spreads. So that's one scenario. And let me put up the staged order entry screen so we could take a look at this. So here's one scenario that plays out. Market sells off hard tomorrow. Net goes in the money. Walmart goes in the money. Lyft goes in the money. Now we've got three positions. Incidentally, we don't have to worry about assignment risk. Right now with the market selling off, option implied volatilities are on the rise. Every single one of these options has plenty of premium in it. So I don't worry that Thursday night we're going to be assigned on a bunch of our short put positions. Not going to happen. What is going to happen though, more than likely, is Friday we'll still have these positions on. What if the market rebounds beautifully on Friday? Well, if we had legged out of these positions again, we would be left holding the bag, and there's a chance they could finish all the way out of the money. We could actually make money on these spreads yet. So what we need to do, and you might be already looking ahead, and you might see that we have a position right here. We are going to buy 5 of the VXX March 19th. So we're going out a month and a half on this position. We're going to buy the $20 calls at $5.50. Now, actually, what we're going to do is we need to buy these tomorrow on the open. I had to put a price out there. I don't want to pay more than $5.50 for them. So I'm going to send instructions tomorrow morning. I'm going to evaluate how far VXX has fallen, or how much it's rallied overnight, how much the market has fallen overnight. I don't know what to expect for the S&P 500 tomorrow. It's down 35 points right now. It could be down 135 points by the open tomorrow. It could be up 50 points before the open tomorrow. I have no clue. I suspect it's going to be a down open with the Apple, Tesla, Facebook reactions, but I don't know. I'm thinking that $5.50 we'll be able to buy 5 of these. We certainly have the cash in the account to do it right now. And this is what our account looks like. You can see these are all of our positions right now. And we've got some extra cash in the account because we closed 3 positions down. And we've got to put up our max risk on the spreads anyway. So our options buying power is basically $5,600. So if we're able to buy 5 of these at $5.50, that will give us a decent hedge. So let's play out another scenario. We buy these and then the market rallies. Holy cow. How could we have anticipated that? It looked so dire and so weak. If the market rallies, I feel that these calls are going to hold their value pretty well. Given the whole macro backdrop right now, I think option implied volatilities are going to increase because you've got a chance for a buying climax on one side and you've got a chance for the bottom to fall out on the other side. I think option implied volatilities are going to stay fairly rich. So if the market does rally, will VXX pull back? Yes, it probably will. These options might go, let's say we're able to enter at $5.50. Maybe they go down to $4. So we lose $1.50 per contract. That'd be about $750 that we would lose on that trade when we exit. Well, what's the upside? The upside is that NET, Walmart, and Nvidia all finish out of the money. We would make $250 on each one of these trades based on the $1,000 per trade that we've allocated and the 25% return. So on each one of these, we should be able to make $250. So our loss from my calculation on VXX could be somewhere in the $750 range on 5 contracts. Our gain, if our spreads expire worthless, would be about $750, so the two of them wash. And we're able to live to fight another day, and then we're able to deal with Nvidia and Netflix next week. Now, the other thing that we're going to have to keep an eye on, and I urge you to watch your emails very, very closely before the market opens and after the market closes. Because if we get through the day tomorrow and the market looks really good and it rebounds, then we may not have to worry about our bullish put spreads, but we may have to exit our VXX position. All depends on how I see the market unfolding tomorrow. Let's say that tomorrow after the close, the market absolutely gets destroyed. Our spreads are in the money. I'm going to send you instructions on how you need to close the spreads down. In essence, if they're all the way through both strikes, you need to instruct your broker that if I am assigned on my short puts, I want to exercise my long puts. That's typically how this works anyway, even if you weren't calling your broker or letting him know what your intentions were, but you should just make sure that you do that. Let's say that the options finish between the strike prices at the close Friday. Then you need to be able to buy back all of your short put positions. Your long put position is simply going to expire worthless. So you'll have to monitor those positions 5 minutes before the close on Friday. If they're in the money or close to the money, buy them back for pennies. If they're all the way in, all the way through, then you don't need to worry about it. I will do another video tomorrow. I'll explain this in great detail. Quite honestly, you should already know about this. I do expect all of my members to be very familiar with option trading strategies. What I really don't want my members to do is to blindly follow everything that I do. Pete's going to make me rich. I'll just follow his trades. The only reason that I do all these trades is because I want a real example. I want to show you what's possible when you're trading, and I feel that the best lessons are learned with real money. That's the only reason that I put these weekly swing trading videos out there. So if you're just blindly following me and you're not learning, shame on you, because someday I'm not going to do this. But I want you to have practical experience, and a lesson like this is invaluable. I've had to go through this myself. It's really, really tough. It's a lot easier when you can trade the markets intraday, but not everyone can. So it's even harder to make these adjustments when you're doing it after hours. So the point that I need to make is number one, legging out of spreads is very, very difficult. If you have no time, in our situation, we only have 2 days. We have incredible time premium decay working against our positions if we leg out. Normally it's working for us. Now if we leg out, it's working against us in a major, major way. Lots of risk. So legging out is not really viable right now. The other thing is that I can't just put on some bearish positions because I don't know that those stocks are going to properly hedge us for the next 2 days. I need something that is going to move with the market because the market is our risk. That's why VXX is our preferred choice. The other part to that is that VXX doesn't move like S&P, doesn't move nearly as quickly. If we get a huge market dump tomorrow, VXX is going to explode. Those option premiums are going to explode. So they will provide us with a fantastic hedge. However, if the market rallies and bounces, VXX is going to hold its value better than an SPY put position will. If we get a huge market drop tomorrow, there's a good chance that we might add to our VXX position so that we can further hedge our NVIDIA and our Netflix position. Because what that will mean is that, yes, we've offset some of our losses on the 3 open positions that we have, but we still have a couple of positions that are hanging out there. When our positions are closed on Friday, then we're going to start taking a look at Netflix. Netflix, I've kind of written off a little bit, although that stock moves like the wind. It's a $550 stock. So for it to recover 40 or 50 points in a couple of days, it does that all the time. And we could take a quick look at NVIDIA, and we'll take a quick look at Netflix also. So we'll do Netflix first. And the premise there was that this breakout was going to hold. I didn't like this retracement, but it was able to hold that low from the earnings announcement, so everything seemed pretty good. Really was kind of worried about the price action. Yesterday it recovered nicely. Thought, okay, well here, we're finally finding some support at 555. We could be in decent shape. Wham! But it also makes those types of moves on the upside. So as long as it's got a good market, once it finds buyers, it can rally back. NVIDIA, which incidentally AMD posted a really, really good number today. It sold off, but it recovered most of the day. Let's take a look at AMD and then we'll take a look at NVIDIA. You can see it touched the 100-day moving average and then rallied back. Even though the market was selling off like crazy, you can see that on a relative basis, market tanking, AMD is actually holding up pretty well. Market makes a new low of the day right there, continues down. AMD trading higher than its low of the day, and it posted a great number. So I think that the graphics card makers are going to hold in there quite well. I still like NVIDIA. I still feel that that support level is intact. It's got earnings coming up, and we can see that horizontal support right in here. We're still way out of the money on it. 497.50 is our short strike price on NVIDIA. So we've got about $20 out of the money with a week left to go. And I thought it held up pretty well. I did not like that it closed below the 100-day moving average today, but all things considered, I'm not writing NVIDIA off just yet. So these are your marching orders. We are going to buy the VXX. We're going to buy 5 of them. Going to buy the March 19th $20 calls, and we're going to buy them at the market on the open tomorrow. These bid-ask spreads are super, super wide. I don't know where they're going to be trading. I need to be able to gauge where VXX is going to open. So even though I have this order in at $5.50, know that an email is coming before the open and that we may need to adjust that price. I don't want to overpay for this protection. I want to make sure we're getting in at a good price. I want to be able to evaluate the overnight market action. So I'm going to send you an email before the open, but that is our game plan. Wish we weren't in this situation. It happens. When you're trading, everything was looking good 2 days ago. Tick, tick, tick. Our positions were in great shape. Another 2 or 3 days had gone by. Then we only have 2 bullish put spreads out there, very little risk exposure, and we're dancing the jig. Not what happened. So we got thrown a curveball. Now we've got to adjust. You saw the thought process behind the trade that we're going to be putting on. And I explained to you why we're not legging out and the dangers of legging out and why VXX I think is going to be our best hedge right now. I'm not trying to make money on VXX. I'm trying to have it offset our risk exposure on the 3 positions that are possibly in trouble. So watch for an email tomorrow before the open. Watch for an email tomorrow after the close. Watch for an email Friday before the open. I'm going to be in constant contact with you so that you know what steps need to be taken every step of the way. If you've been watching this on YouTube and you've gone through the entire video, congratulations. I think that you've probably just seen how you can handle positions that have gone badly, and you'll also be able to see how this strategy worked because you'll be watching it 2 days after the fact and you'll know exactly how we weathered the storm. Thanks so much for watching. If you like the content, please give it a thumbs up. Make sure to subscribe to the YouTube channel. Turn on your notifications so that you never miss these videos. And for all members, know that I will be in contact with you. Thank you. Good night. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.